Okay.
Okay, cost of goods sold as a percentage of revenues. What does the case say?
20% of sales in 2015.
2016?
21.
21?
Yeah.
So again, what does that say? They're saying based on their understanding of the business, for every dollar of sales, about 20 cents goes to pay the suppliers, the things that people are buying and so on. And you expect that to go up. Selling expenses as a percentage of your revenues. 25, 26, 27%. Your general and admin expense. So variable, general and admin, salaries, light, water, internet, as a percentage of revenues? 5%. 5? 5. All across. And fixed general and admin expense.
Increasing by 50,000.
50,000 each.
Okay, so how is that set up? So we're doing the rent option first with 15% growth, right? So this is what it looks like. 675,000, then 725,
Yeah.
and then
775.
okay. Everybody good so far? Everything there is given, you don't look happy. You're looking at it suspicious. Oh, you're looking at it suspiciously. Like you're vexed with it. So depreciation. Existing equipment. What is given? 95,221.
Yeah.
All the way across. 95,221. Building.
36,667.
Do we need that under the rent option? So the building will only apply if, right now they don't own a building. So if they go with scenario, so we're doing scenario 1 where they are renting, so they will not have a building. Everybody clear on that? They will not have a building, so there will be no depreciation on the building under this particular scenario. Everybody comfortable with that? Okay. And then new equipment? So there's nothing here.
Oh, okay, that's
10,000.
10,000.
10,000. So then we can have a total. That plus that. Plus that. So the games. High money. They don't like us. Okay, interest expense. Under the rent option, do they have any interest to pay? I don't think so. There shouldn't be any interest. And they're very fortunate, they are in a tax, they don't have to pay any taxes. You give them what they call zero tax. Okay, receivables, a accounts receivable, debtors. You don't want any excitement. No insurance isn't that strong. Receivables as a percentage of revenues, anybody? What do they tell you? 2% for each year. Inventory as a percentage of revenues.
8% each year.
Release it. Hold on here.
Accounts payable as a percentage of revenues
4%.
each year.
Yeah.
Accrued liabilities, do they have any assumption on that? My memory is no. My memory is not good. Hmm?
No.
Okay, additions to property, plant and equipment.
100,000.
In what year?
2016.
So there's nothing in 2015.
No.
Alright, and then 100,000, and then nothing.
It depreciates a little.
But in terms of adding, getting, so
No,
there's-
nothing there.
Okay, everybody good with all these assumptions so far? They are all given. They're all given in the case study. Okay, debt. Are you borrowing any new money? Additions to the debt. Are you borrowing any new money? Any new money from the bank under the rent option? Okay, see the brother there nodding. And not counts as class participation. Reductions in the bank loan, are they paying off anything?
No.
I think they are.
Yeah,
2015, how much is it? So let's look up at the balance sheet. How much do they owe to the bank? On the 24th, at the end of 2014, how much do they owe to the bank? 159,579. So they plan to pay that off, right? I don't think, under the buy option, they're not taking on any new long-term debt or. Everybody's good with that? Everybody clear?
Yes.
And they don't plan to put in any new equity, I don't think they tell us that. And how much do you want to take out every year as they're drawing? What's your salary for the year? 75,000. So these are your best guesses about the future. So in a way, so to do the forecasting, we're using a very simple. So this is an ABC, very basic forecasting model. So we don't want to offend anybody with simplicity. Just to show the mechanics without getting into complexity. Without spelling it out, what these assumptions are kind of based on is that the level of sales is the driver. That all the other, most if not all of the other things in the financial statements depend on the level of sales. Which is why all of these things are as a percentage of sales. So usually when you're doing a forecast, you want to identify what is the driver. What is that thing that when it changes, everything else or most other things will change? So now we are probably kind of ready to just do some of our forecasting. So again, it's a very simple model. So what would you expect? So based on these, what is the forecasted sales for 2015? It would be equal to the quantity, the unit demand, right? Multiplied by the selling price. So the prediction here then is, if you get that growth as they expect, you expect revenues to be about 2,042,581 in 2015. So again, very simple model. What would you expect, based on the assumptions, what's the projected cost of goods sold? What is your cost of goods sold assumption? Cost of goods sold is?
21% of sales.
Right, so 20%.
Or 2015.
Of the forecasted revenue. So you would expect that your cost of goods sold would be about 408,560. So what then would your gross profit or gross margin be projected at? Revenues minus your cost of goods sold. Everybody with me? That's easy peasy. Selling expenses, what's your prediction?
25% of sales.
25%. Sales. Your variable, general and admin. %5
Yes.
of your sales. Your fixed, general and admin was your 675. Here. What is your depreciation forecast? $95,221. So what are your predictions for your total expenses? The sum? And your profit before tax, earnings before interest and taxes, EBIT. Last week we talked a lot about operating income, income from your core business. So EBIT is pretty much another term for that. So EBIT is your gross margin minus your, what's your net interest expense? Nothing? So what's your taxable income? Earnings before taxes. Now you're taking out. It will be your EBIT minus your interest. So it's the same?
Mm-hmm.
What are your taxes? Taxes. Again, I think it's always useful to pull it from your assumption sheet, because it allows you to change the assumption and have the spreadsheet still work. So what's your net income? EBIT minus your taxes. And if you've done your spreadsheet properly, you should really be able to just copy this across. And get the forecast. 10 years and you set it up properly, you just get it done just as quick. Okay, so let's go in now to our balance sheet. What's our receiver? I'm going to start with receiver. So cash is often a funny number, you know. So when you're doing a projected financial statement, there are some numbers that kind of drop out from something else. Or then we call them balancing items. So cash is often one of them. And if you look back at the assumptions, there was an assumption about cash. Right? So if we look down here, there's really no assumption about cash. Let's start with what we know. Receivables. Just going to put zeros there for now. The spreadsheet. Receivables. What's your assumption? 2% of your sales. Okay. You have a forecast for receivables. Everybody good with that? What about your inventory?
8% of sales.
So it's 8% of your sales. So you have a forecast there. So what's our total current assets? Cash plus receivables plus our property, plant, and equipment. How might we do that?
Historical cost.
The figure for last year, right? What are we gonna add to that?
The new addition.
Additions, right? So we're gonna, any addition. So
140.
we didn't buy anything, right? So it's gonna stay the same. Depreciation. So that's kind of our accumulated depreciation. So it's last year's plus the expense for this year. Okay, so it's your accumulated depreciation. So depreciation on the balance sheet is a running total. Also, you would add to that the expense for the year. Okay, so it's the amount from last year plus the expense for this year. Everybody with that? So that's basic accounting. So what's my total fixed assets? Property minus the depreciation. And my total assets would be my current plus my fixed, right? We know we haven't put any cash. We'll deal with that. Accounts payable, what's our assumption?
4% of sales.
Okay, so accounts payable, 4%? 4%. Of our sales. So we have data there. Accrued liabilities, we don't have any. What about the bank loan? It's the amount from last year. What would we then do? We would add plus any additions, right? Minus any reductions. So we started with a balance at the end of 2014. Did we add anything in 2015? So we would plus that and we pay off. Okay, so it's gone to zero because as said in the case, you were going to pay it off. So it's the amount from last year plus any additions minus any reductions. So what's our total current liabilities? Accounts payable plus accrued liabilities plus our bank. So our long-term liabilities. Same logic. The amount from last year plus any addition minus any reductions. We still don't have any, so our total liabilities would be current plus long term. Shareholders' equity. Last year's amount, plus did we bring in any new shares? So no equity. So retained earnings, how does that work? Previous year,
Net income.
plus our net income. Net income minus dividends. So in this case, our owner wants to take a 175. So that would be our equity. So our total shareholders' equity. Okay, everybody good with the retained earnings? So keep this a running sum. So our total liabilities plus shareholders' equity. Total liabilities. So we know we're not good because our balance sheet doesn't balance. So we haven't put in any cash. So let's look at the cash flow statement. Let's do that for 2015. What does the statement start with? First thing is net income. So we take that from there. We want to add depreciation. So a depreciation. 95,221. Then we want changes in working capital. So if there is a decrease in if there's a decrease in receivables, then that's an increase in your cash. Okay, a decrease in receivables means that customers, people you're selling, so what's happening in the course of a year? You start with a certain amount of debtors. You are giving new credit, but all people are paying off their credit, so what's the net effect of that? So if your receivables figures fall, it means that you collected more
Increase.
than you extended. So what's the change in receivables? New minus old. So what happened to your receivables? It went up, so that's
Good thing.
it's a negative, huh?
Oh, negative. Okay. Negative.
Put that in brackets and put a negative brackets, so that's gone. Inventory. What happened to your inventory?
Increase.
New minus old. So your inventory went up by 19,649, which is really a use of cash. What about accounts payable? What happened to it? New minus.
Going on. You can type it in.
You should laugh at it.
What?
Minus.
No, it's F20.
19.
F20.
F19.
F20. Minus FE20.
20.
Yeah.
So accounts receivable increase. You got extra credit, so you bought stuff from your suppliers, but you haven't paid them off, so that helps you with your cash flow. It's a source of cash. Change in your accrued liabilities, we don't have any. Wonder why that is there.
We'll have to. Isn't it 21?
This should be zero.
Yes.
Change something?
Accrued liabilities was blank, right?
It was blank.
Yes.
This should be zero.
That was 0, right?
This should be okay now. No?
No? It's
What
okay.
on earth is that?
Accrued liabilities. That's accounts payable.
That's correct. So this one is okay. So what's my cash from operations? It's my net income plus depreciation less the increase in accounts receivable, less the decrease in receivable, in inventory, increase in decrease in inventory. Increase plus increase in accounts payable. Okay, so I'm ending up 349,912. Did I acquire any new property, plant, additions to property, plant, and equipment? But I don't have anything, so that's a zero. Don't think I have any other investments. So my cash from other investments. Additions, reductions to debt. It's equal to additions to debt minus reductions. So I spent 1,579 on paying off some debt. Everybody still with me? In terms of equity, have I done any new shares? Nothing. And what has happened to the dividend? I'm just putting the minus sign because you're actually paying out some money, right? So from my financing side, what has happened? Paid down that in debt. I didn't have any new stock. I paid 175. So really I used my cash. I used 334,579 in cash to pay off debt, and then the owner took out 175. So what's my change in cash? It's cash from operations plus that. So my cash balance is supposed to have gone up by 15,133. Everybody following that? see. So my cash on my balance sheet should be equal to this 43. You go the balance of last year plus change in cash. And we kind of know we have probably done it right because
Balances.
our balance sheet balances. And we kind of should now be able to copy this across. If we set it up properly, we should be able to. So if everything works, that's great. It should fix when we do this one. Let's see, it's all balance sheet balance. Oh, it's not. So what is, so maybe let's do it, let's not be so ambitious. And do it 1 year at a time. We might be able to pick up where we are off.
Maybe check the accounts payable.
Sorry?
I will check the accounts payable because it seemed to have, maybe that's when it went wrong.
With the formula,
Yeah, like if it was in F20 instead of F19 or something like that.
accounts payable
Is that correct, payable?
F53, times N5. That's like a really hard formula. So let's see, accounts payable was,
Focus on this,
that's F53, that's right.
okay.
Times our revenues, right?
Yes.
That's okay. Can't blame him. So let's see if any of these numbers look a little shocking. Property, plant, and equipment. You did buy, I think we did buy the 100,000. That's the depreciation. 455. Okay, so accounts payable, bank loan. Let's go across. Income statement should be fine. So let's see. So we have that. We have a new depreciation figure. So let's see here. Let's see, this is our net income. Our depreciation figure. 105 to 21. So what happened to inventories? So they went up. Sorry, receivables. Seems fine. Accounts payable. Zero. Additions to property, plant, and equipment. 100,000. And that's a negative. Because you're actually buying that, so that's a negative. So that's a negative. I don't think we have any reductions in that. That should be 0. Cash provided by negative 175. No change in cash. 10912. Okay, so our balance sheet now balances 564, 669. Okay. So we just need to be a little patient. Let's see if I take the whole thing. So we are in business. So now you have done the forecasted statements. Now one of the, so there could be a pick. So this is scenario 1, rent 15%. We could vary, this doesn't always work as well. So the next step, right, maybe let me do that. The next step would be the ratio analysis. So let's take a short break and come back. Sorry? You were looking forward to that, weren't you? Let's see, 2030, let's do ratio. All right, I'm gonna give this young lady a wish. It wasn't you? Let's take it.
So that seemed like a lot of work, even though he said it was easy and straightforward. I'm just saying. Yes.
It is a lot of work.
So sir, we can upload this?
The solution.
If you all behave.
Okay.
But you want people's money. So you gotta do the work, something that will
Yes.
somebody else who does the work will get the money.
Okay. It's better to do it yourself than to hire an accountant or somebody, right?
Sorry?
It's better to do it yourself than to hire somebody to do it
Well,
for
we're
you.
not saying that. It's,
I'm saying.
well, you are supposed to be able to do it, huh?
Yes. I just think you're crazy. Throw you out. Oh, it's so sharp. Hide it.
Yes, I think we have a little bit more of hard labor to do. But preliminary, looking at the financials, how does it look? If she borrows, if they rent and they get the 15%, the profits seem to grow. Okay. Steady growth in cash. Big jump in their cash actually. Doesn't look too bad. It's looking bad. The equity looks okay. So what are some of these financial ratios that you look like in terms of the financial analysis? So liquidity. So under liquidity, you have two ratios, right? Given. So what do you have is the current ratio and the what? Quick, I think. Is that? Current ratio and quick ratio. I guess just to keep it for speed, I'm just gonna avoid some of that averaging. So what's your current ratio?
Current asset divided current liability.
So it's your current assets divided by your current liability. Okay? We wanna get that as a number. Okay, the idea is once you do copy that across. So, you know, if the rent and the growth happens, the liquidity seems to improve, and the quick ratio is what? So your current assets minus your inventory. So total current assets minus your inventory. By your current liabilities. So again, that points to improving liquidity if those numbers play out. Everybody with me? Next category. Cash conversion cycle. So anybody, what does the cash conversion cycle try to tell us? What are you trying to capture? So you sort of think that, I guess you're thinking of sort of a retail or manufacturing business. There's a cycle. So as you run the business, the first thing you do is that idea is that you might use your own money to acquire inventory. How long does it take before that inventory is sold to give you some cash? So inventory to sale. You know, how much time does it take for the inventory that you've acquired to be sold so that you get it prepared to be sold? Then sale to cash. Because some of your sales are on credit, so how long does it take to convert that to cash? So you can think of these two bits, time, it's a period of time when you are out of cash in your business. You've put out cash to get inventory. And some of that inventory has been sold on credit, so you've been collecting cash yet. And then purchase to payment. So some of the stuff that you buy on credit, which helps you to save cash. So then your cash conversion cycle is inventory to sale plus sale to cash minus purchase to payment. inventory to sale. You know, how long does it take before your inventory become actual sales? Sales to cash. How long before your sales revenue becomes cash?
Okay.
And purchase to payment, I think they call it. Nice way of putting it. Then we can put these together as the cash conversion cycle. So what's the formula for inventory to sales, anybody? Remember that first. Inventory divided by cost of goods sold on 365. So we can probably only do that from 2014. Because we don't have an income statement for 2013, right? So we can. So for 2014, the numerator is your inventory divided by your cost of goods sold divided by 365. Assuming the 365 day here. Oops. So what does that number tell you?
Inventory to sales.
So when you it takes about 147 days of the 365 days in the year before your inventory becomes sold.
Oh.
Sale to cash. What's our formula there? Receivables divided by sales divided by 365. It's our receivables divided by sales on 365. Okay, so we really don't give a lot of credit. You know, once the sale takes place, we get our cash pretty quickly, 7.3 days. And how quickly do we pay our creditors, the people who sell to us? Payables plus accrued liabilities. Numerator accounts payable plus accrued liabilities. All divided by our cost of goods sold on 365. Okay, so we don't treat our creditors that great. We're taking about 54 days, almost 2 months to pay. So what's our cash conversion cycle? Inventory to sales plus sales to cash minus, that's 90 days. So it really means, maybe in a more practical sense, that you kind of need to have enough cash to carry yourself for 100 days. Because the way your business operates, it actually takes when you stock your shelves, it takes a little while to sell. So you've put out that money to acquire that inventory. Now you got some of it on credit, which is why we subtract that. But then you give some. So how does that work with your growth plan? Okay, so all good. To some extent. Your liquidity. Because again, the bank and the lender might be interested in that. I mean, are you going to have enough cash to service the loan and run the business? And we have your leverage ratios.
Can I ask again, what is cash conversion cycle? What does it mean again? If you don't know.
How long, how long are you gonna be out of cash?
Okay.
So with the inventory to sale, so what's happening there? If you think of it about, just think of money. You start a t-shirt shop. So you have to put out some money to get the t-shirt. So you are out of cash. So you need to spend money to stock your store.
Sure.
So when you stock your shelf, how long before the items get sold on average?
Okay.
So that's the amount. So you're kind of out of cash in that period.
Mm-hmm.
You spent your money there and you're begging customers to come through.
Right.
Now when you sell, some percentage of it is on credit. So what's the time period when you have sold some stuff but you ain't collecting any money yet? So probably a lot of these sales are not on credit. Probably don't make sense to sell beauty supplies on credit.
Okay.
People gonna, the girl's gonna use it to pretty up, they can't recollect it, it doesn't work. But you manage your cash a little bit by leaning on your creditors. How long do you take to pay them? Okay?
Okay.
Does that help?
Yes, yes. Start with
Leverage, how indebted are you? So debt to assets and interest coverage.
decreasing.
Okay, so debt to assets. How much do you really owe? Debt divided by total assets. And there are kind of different ways you could think about it. I'm just going to do the total liabilities divided by your total assets. So in terms of running the business, you have assets that you're using. You spend money for these assets. How much of that money was borrowed, a percent? So 43% of your assets were paid for by borrowed money. If I put the total liabilities divided by total assets. Okay, so now, high, low, judgment call. But what might be important, can you service this debt? So the level of debt is important to know, but can the business meet those debt payments? Can you service that? So it's your EBITDA, earnings before interest, taxes, depreciation, and amortization. So EBITDA, again, another important number in finance, EBITDA, earnings before interest, taxes, depreciation, and amortization divided by interest expense. So you sell stuff, you get revenues, you pay your expenses. How much do you have left to service interest? Okay, so what's our EBITDA? So it's our EBIT. And we add back depreciation. Why do we add that back?
Because it said before depreciation.
Okay, so we're looking at your ability to pay your debts, interest coverage. Why do we add back depreciation to EBIT? Because depreciation is not cash. You didn't actually spend any money. Divided by your interest expense. So you're going to get a funny number there because you don't have any interest expense. So that's good because you don't really have any interest expense. So these things you have